A couple of days back, I came across a tweet from a trader saying that the new STT rules and the way the market is behaving, things are getting quite worrisome, and that there are almost no opportunities left to trade. Maybe even expiry day trading as we know it could come to an end. Now, if you really think about it, what they are pointing to is a shift, that the market is no longer the same as it used to be. And this is where people often use the term market regime to describe what's happening. But have you ever stopped to think what exactly is a market regime? What does it really mean? And that's exactly what we will explore in this episode, breaking it down and looking at different perspectives to better understand market regimes. I'm your host Sandeep Rao, and with that, let's get started. As with most things in the markets, one of the key lenses to look through is time frame. So when we talk about a market regime, the first question we need to ask is on what time frame? Are we looking at intraday, daily, weekly, monthly, or even yearly data? Because each of these becomes a unit of analysis when we define a regime. To give you an example, things may not have changed on a week-on-week basis, but they could have changed significantly on a daily basis, and that's entirely possible. For instance, if on average the Nifty 50 continues to move about say 1% per week, that broader behavior may not have changed. But the intraday high-low range could have expanded or contracted significantly. In such a case, you would observe a change of regime on an intraday time frame, but not necessarily on a weekly one. The second important aspect after time frame is persistence. Any change we refer to as a regime should sustain itself. It shouldn't revert immediately back to what it was before. It needs to hold for a meaningful period of time for us to consider it a new regime. Now, that also implies that we need ways to measure it, but for now, just think of this as a defining characteristics. A regime needs to last. For example, a trader might look at the India VIX. A rising VIX environment could be considered one regime and a falling VIX another. But a one-day spike, even if it's sharp, wouldn't really qualify as a regime change. So in essence, when we talk about a market regime, we are referring to a change in certain parameters of the market observed over a given time frame that persists over time. With the definition in place, let's take this a step further. When we think about market regimes, they typically belong to three broad pillars. Let's start with the first one, the macroeconomic perspective. These are like deep sea currents, slow-moving but powerful forces that shape the overall direction of the market. The first factor here is interest rates and inflation. At a fundamental level, what really matters is the real interest rates. That is, interest rates adjusted for inflation. This effectively becomes a hurdle rate for investors. For equities to remain attractive, returns need to exceed this baseline, which is why real rates play such a critical role in shaping market behavior. Next, within this macro bucket are institutional flows. In India, for instance, we often hear about foreign institutional investors, FIIs selling, while domestic institutional investors, that is DIIs, and retail investors step in to absorb that supply. While these flows don't always directly dictate market direction, but they do influence trend and liquidity, making them an important input when thinking about market regimes. It's also useful to look beyond India and track flows across other emerging markets. For institutional investors, these markets are often the alternatives. So when capital moves out of one geography, it typically finds its way into another. Understanding where that money is going and why can provide additional context to the prevailing regime. The third factor is currency strength. Since a large part of corporate earnings through imports and exports is influenced by currency movements, shifts in currency can have a meaningful impact on the markets. You may have seen recent discussions around Nifty 50 not moving much in US dollar terms, and that perspective comes from looking at the market through the currency adjusted lens. trends in the Indian rupee relative to the dollar can themselves signal a distinct regime. Finally, we have key commodities, especially crude oil. For a country like India, which is heavily dependent on oil imports, changes in crude oil prices have a distinct impact on inflation, fiscal dynamics, and corporate profitability. Events like the current geopolitical tension in West Asia often feed into oil price movements and in turn influence the broader market. Taken together, these macro factors, real rates, flows, currency, and commodities, form one important lens through which we can define and understand market regimes. Then there are some events which are both macro and structural in a sense. And if we look at it in the past 2 decades, at a global level, one of the most defining structural shifts was the advent of quantitative easing or QE in late 2000s, where central banks began injecting liquidity directly into the financial system on an unprecedented scale. Across the world, pre-QE and post-QE markets behave quite differently in terms of liquidity, asset correlations, and how risk is priced. I would say that this single policy shift effectively changed the markets forever in the past 2 decades. Close to home, India's economic liberalization post-1991 is perhaps the most consequential regime change in our market's history. The opening up of the economy, allowing foreign capital, dismantling licensing constraints, and integrating India into the global trade created a fundamentally different market from what existed before. Pre and post 1991 are in every sense 2 very distinct regimes. And even within the post-liberalization era, there was another critical turning point: the establishment of SEBI as a regulatory authority with real teeth. Before that, markets were vulnerable to large-scale manipulation as seen in episodes like the Harshad Mehta scam. The transition from that relatively unregulated environment to the one with formal oversight and enforcement created yet another distinct regime. One defined by greater transparency, investor safety, accountability, and structured participation. Then we had the electronic markets era. A little later, we had index derivatives, all of which had significant impact on the market and could be called regimes by themselves. With SEBI comes our second pillar in defining market regimes, what I would call structural and regulatory changes. Unlike macro factors, these behave more like what they call step functions in math. They change suddenly and then persist in that new state. The first and the most obvious example here is taxation. In India, for a long time, there was no long-term capital gains tax. And then at a certain point, it was introduced. That single change effectively divides the market into 2 distinct phases: pre and post long-term capital gains. Similarly, changes in STT, which is Securities Transaction Tax, especially multiple revisions over time, can be seen as separate regimes, particularly because they have a direct impact on trading behavior in derivatives like futures and options. Next are structural or operational changes. For instance, the introduction of the pre-open session fundamentally changed how price discovery happens at the start of the day, and in turn impacted intraday volatility. Markets before and after such changes tend to behave quite differently. Another important dimension is what we can call the leverage regime. The peak margin rules that came in December 2020 effectively reduced the leverage available to traders. That in turn has an impact on participation and risk-taking behavior across the market. Then there's product evolution. Over time, the market has seen the introduction and expansion of different derivatives, starting with Nifty 50, then Bank Nifty, followed by weekly options, and then later additional indexes like Sensex, Fin Nifty, and mid-cap indexes. More recently, some of these weekly expiries have been phased out, bringing us into a different regime. Each of these shifts impacts how capital is allocated, where it flows, how efficiently it gets deployed, and how much it can be absorbed within a given product. Closely related to this is the settlement cycle. A move from T+1 to faster settlement frameworks changes how quickly capital can be recycled, which again has implications for liquidity and participation. Finally, there are regulatory interventions aimed at curbing excessive speculation, such as the ASM, Additional Surveillance Measure, and GSM, Graded Surveillance Measure, frameworks introduced by SEBI, the Securities and Exchange Board of India. These directly impact price behavior and trading activity in specific stocks. In essence, all of these structural and regulatory changes influence how capital flows through the market. When one product or segment becomes less attractive due to higher costs, tighter regulations, or lower leverage, that capital eventually shifts to the next best alternative. We've seen this play out, for example, with the relative decline in futures activity compared to options, largely driven by the differences in transaction costs and capital efficiency. So, in summary, structural and regulatory changes are powerful drivers of market regimes. They create lasting shifts in behavior, participation, and capital allocation. So far, we've spoken about two key drivers of market regimes: the macroeconomic factors and structural and regulatory changes. But there's a third lens, what we call a micro or market structure lens. This is something we apply directly to the market itself, indexes, or the underlying stocks. At a very basic level, you could define a regime based on direction. For instance, whether the Nifty 50 is trading above or below its 200-day moving average, that in itself can define a regime. If you are a trader, it's hard to ignore volatility as a regime. Whether you look at realized volatility or implied volatility, each creates a different environment. And that, in turn, influences the kind of trades you take and the level of risk you are willing to assume. You could also define regimes based on distance from all-time highs. Markets trading within, say, 10% of their highs versus those significantly below it tend to behave differently. Moving beyond the index, you can look at the market breadth. For example, the percentage of stocks near their highs or the percentage trading above their 50-day moving averages. That gives you a sense of how broad-based the participation is, which itself can signal a regime. Then come factor-based regimes. There are periods where value outperforms momentum or where low volatility strategies dominate. Growth, value, momentum, each of these factors can lead the market at different times, and tracking them helps identify the prevailing regime. And finally, there's market cap rotation. At times you will see strong moves in small caps followed by phases where mid caps or large caps take the lead. These rotations are quite visible and can be used to define regimes based on which segment of the market is outperforming. So through this micro lens, whether it's trend, volatility, breadth, factors, or market cap rotation, you get a more immediate ground level view of how regimes are evolving within the market. Lastly, I want to share something from my own experience with market regimes, because I think it's important to be honest about it. You see, it's really easy to identify regimes in hindsight. You look back at a chart and the shift is obvious, right there. Plain as the day, as they say. But living through that shift in real time is a very different experience. When you are in the middle of it, the question always is this a genuine regime change or just one-off thing? Is it going to persist, or will things get back to how they were? That question is far easier asked than answered. There's another important distinction worth making. Some regimes are relatively easier to track, particularly those derived from price or other quantitative factors. Volatility regimes, trend regimes, breadth-based regimes, these can be modeled, measured, and monitored. You may not be able to predict them with certainty, but you can make some informed assessments. You can ask, has the shift lasted long enough? Are the conditions in place for it to continue, or cracks are beginning to show? But even with all that, most of this understanding and clarity comes only in hindsight. And I think that's the humbling reality of the markets. Understanding regimes, while it's really valuable, the skills required to actually navigate a regime shift while it's unfolding, which means to act on incomplete information, manage uncertainty and stay disciplined, well, those are different set of skills entirely and perhaps the harder ones to develop. So yes, that brings me to the end of this episode. I hope you found this episode useful. If you have any questions, feel free to drop them in the comments. I'll be happy to respond. Till then, take care and trade safe. I'll be back with the next one soon.